The Indian rupee has crossed a significant mark, trading above 90 to the US dollar. This development has captured market attention and raised questions regarding the currency's trajectory. The exchange rate currently stands at 90.38. While such round numbers often serve as psychological barriers for the market, a thorough analysis requires looking beyond the headline figure to the underlying economic forces. Current analysis indicates this movement does not represent a structural crisis. Rather, the rupee's valuation is a direct reflection of fundamental supply and demand dynamics playing out in the global foreign exchange markets. This analysis will deconstruct the rupee's movement across 5 key areas: the mechanics of currency supply and demand, India's current account deficit, headwinds in capital flows, broader market pressures, and a concluding assessment of the data and outlook. We begin with the core principle governing all currency valuations. At its most fundamental level, an exchange rate is the price of a currency, determined by its supply versus the demand for it. When capital leaves India, for example through import payments, the global supply of rupees increases, which can weaken its value. Conversely, when capital enters India through investments or exports, demand for the rupee rises, strengthening its value. The rupee's current position is the result of supply exceeding demand. The first major component influencing the supply-demand balance is the current account, which primarily tracks the flow of money for trade in goods and services. The current account is a comprehensive record of a nation's trade transactions. It records all payments for imports and exports, along with other transfers that do not create a future claim or liability. India maintains a structural current account deficit, where the value of imports consistently exceeds the value of exports. This deficit typically ranges from 2 to 3% of GDP, resulting in a persistent net outflow of rupees. This structural imbalance, with the import bill consistently outweighing export earnings, creates constant underlying downward pressure on the rupee's exchange rate. The primary drivers of import pressure include oil, gold, especially with strong festive season demand, and a rising consumption of electronics, components, and digital services. These contribute to a higher import bill and a greater supply of rupees on the market. On the export side, multiple headwinds are present. U.S. tariffs have dampened demand for key goods like textiles and jewelry. While exporters are seeking alternative markets, this transition requires time. Furthermore, domestic GST cuts, while stimulating local consumption, have also increased demand for goods with imported components, exacerbating the trade imbalance. Historically, India's current account deficit has been offset by inflows through the capital account, primarily from foreign investment. These capital flows created rupee demand and provided stability. However, recent trends indicate a shift in this dynamic. The capital account tracks financial flows that create future obligations. This includes foreign direct investment, portfolio investments in stocks and bonds, and loans. These activities create immediate demand for the rupee. 3 recent trends have weakened this source of rupee demand. First, exits by foreign investors are increasing. As private equity firms and other institutional investors liquidate positions, they convert rupee proceeds into foreign currency, increasing the rupee supply. Second, outbound investment from India is on the rise. While a positive sign of a maturing economy, Indian individuals and corporations buying assets abroad adds to the supply of rupees in international markets. Third, foreign portfolio investment in Indian equities has weakened. Despite the inclusion of Indian bonds in major global indices, geopolitical tensions and reduced risk appetite among global investors have led to a pullback from equity markets, reducing demand for the rupee. Beyond the current and capital accounts, additional market pressures are influencing the rupee's exchange rate. Several other factors are exerting pressure. The Reserve Bank of India is intervening not to prevent depreciation, but to manage its pace and reduce volatility. Recent repo rate cuts, aimed at stimulating the domestic economy, have reduced the appeal of rupee-denominated assets for foreign capital. High liquidity in the banking system also facilitates rupee selling. Finally, speculative trading and corporate hedging add further layers of price pressure. Synthesizing these factors provides a clear assessment of the current environment and the forward-looking outlook for the currency. In the near term, challenges persist, including strong import demand and subdued foreign investor interest. However, long-term indicators remain positive. India's economic fundamentals are solid, government reforms are ongoing, and the market's reaction has been measured. The rupee also appears undervalued relative to its international peers.
This assessment reinforces the core thesis. The current exchange rate is not the result of a fundamental weakness, but rather a convergence of temporary headwinds impacting both the current and capital accounts simultaneously. The rupee's depreciation, therefore, reflects a period of adjustment to these overlapping pressures, not a structural breakdown. The underlying fundamentals of the Indian economy remain strong.
For long-term investors, the focus remains on discipline and asset quality. The key forward-looking question, however, is when capital flows will stabilize, allowing the currency to find a firmer footing. The timeline for this stabilization remains the primary uncertainty in the market.